Good morning, and thanks so much for tuning in. We were delayed just a bit because of the interaction with HDFC's Keki Mistry about the company's Q2 results. If you'd like to watch that interview, do tune in to BloombergQuint.com. In the meanwhile, this is Stocks to Watch on BloombergQuint, and I'm Alex Mathew. My guest today is Mayuresh Joshi of William O'Neill. Apologies for the delay, Mayuresh. Thank you so much for taking the time. Good morning to you. I want to start by asking you about NTPC's results. The revenue came in 8.4% higher, 24,677. Not too much below the expectation, but net profit has come up higher than expected at 3,500 crore rupees. EBITDA margins coming in at 29.1 versus 27.9. Here, there is a slight dip. It was expected to come in at 31.3% according to the consensus estimates. But I think a lot of people will be interested in that buyback announcement, which was priced at a 29% premium to the share price yesterday. So all of these things put together, how do you view the company?
Morning, Alex. Thanks for having me onto your show. So it's been a mixed bag for NTPC of sorts because the revenues which have inched up 8.5%, a tad bit above expectations. Margins, yes, I think the performance, again, more or less in line with the majority of estimates on the street. But the bottom line growth has been accentuated because of the exceptional gains and lower taxes. And therefore, I think the kind of growth that you've probably seen on the bottom line is probably because of these one-offs. Now, coming back to the core business itself, where the large expectations have been laid out, that they did commercialize 5.3 gigawatts of capacities in FY20. The expectations is that the capitalization run rate might very well continue between 5 and 6 gigawatts for the next couple of years. And that probably guides its regulated ROEs. So the expectation with huge commercialization happening, capitalization happening, will obviously lead to improvement in regulated ROEs going forward. Second element, obviously, is also to look out for in terms of outstanding overdues. So you're close to around 14,500 crores at this point of time. And the expectations of more coming through and reduction of overdues might probably help the balance sheet. The third angle that you probably can look at from a company perspective is probably the dividend yield and the free cash flow yield. So that remains extremely strong for NTPC at this point of time. And with government coffers, because of tax revenues expected to be low, I think the dividend payouts might be on the higher side. What might also support, Alex, is the buyback announcement that you rightly pointed out, and that can have a sentimental impact. However, as per our O'Neill methodology and what we probably look at in terms of our earnings ratings, the RSI rating, and the overall master score that we've got, it still lags because of the inconsistency that it probably posts in terms of reported numbers. So I think as consistency will start coming through, and it's very difficult to say that because I think the PLFs, PAFs, and the power demand, those showing some amount of respite, might take some time. So I think sentimentally, I think the stock might react positively, but as per our O'Neill ratings, I think there is still some time to go for the stock before we probably re-rate this.
Understood. Which brings me to the second stock, and I understand, that the development that we're going to talk about in terms of why we're talking about it is not that large. Sterlite Technologies to acquire Italy's Optotech for 29 million euros, which frankly is not a lot of money, is going to complete the acquisition by the end of 2020. But I thought it'd be interesting to use that as a springboard, Mayuresh, to talk about the company, because you're talking about the second half. At least the company expects that it's going to be better than the first half. And I think it's pinning a lot of its hopes on the adoption of 5G globally. Now, the question remains, on the one hand, you could possibly say with a large population, being a little cautious, staying at home, lockdowns, etc., you could have a significant use of that 5G service, and therefore there is that. But on the other hand, those lockdowns mean that work may not really happen. So in that sense, how do you rate this company?
So it's a catch-22, right, on whether it might or might not happen. They did manage to do an acquisition. The numbers were quite reasonable enough, even from operating performance in the quarter gone by. However, from a larger perspective in terms of the adoption of 5G and 5G technology itself, the fiber optic cable outlay globally as well as locally, I think there is still a lot of potential on that front. And the second front is obviously in terms of the pricing of spectrum globally as well. So I think you have to probably consider both these angles in in tandem. What also happens in terms of the China 1+1, right, and the expectations of some and majority of global economies probably looking at players alternative to China at this point of time. There exists a lot of opportunities. So you've already seen some announcements done by Tech Mahindra as an example in terms of the 5G technological outlay and what happens in terms of the physical outlay for fiber optic cables thereof. Therefore, I think the opportunities are huge, but I think both these angles need to be played out in tandem. And therefore, I think data consumption, what happens in terms of the consumption of data worldwide, I think that's obviously going to improve with better band availability in terms of 5G data availability. But I think in terms of numbers to get translated into balance sheet takes time because they're all capital intensive projects. So let's wait and watch. I think let's see the developments on this space.
Okay, fair enough. So there's a wait and watch on Sterlite Technologies. The last counter that we're talking about has already run up significantly. So I'm very keen on hearing what you have to say about Cadila Healthcare's numbers. The revenues came in nearly 13.5% higher, 3,820 crore, above consensus estimates. You have net profit rising 4.4 times to 473 crore, which also was better than consensus estimates. And you had, margins coming in again better than expected at 22.6%. And this is despite an exceptional loss of 132 crore in the current quarter, and of course an exceptional loss of as much as 280 crore in the base quarter. Having said that, you've seen Cadila Healthcare rise along with this entire theme that is been playing out for the last several months. So how would you rate it?
So clear disclaimer, Alex. We had suggested this to our investors, and we are holding on to this stock with a stop loss of 390 odd rupees. Now coming to the numbers itself, I think the margin performance was quite good when you do a YOY comparison at 22.6 odd percent. But the best part about the numbers, apart from the India growth, which grew at 11 odd percent, and it's in the key product profiles that you're probably looking at: anti-infectives, pain management, Gynac, and even the US business growing at 18% YOY with the 6 odd launches, the expectations of a very, very strong pipeline, specifically in the complex injectables business, which is a high margin accretive product, adds to the earnings estimates for this company as well. But the best part, again, as I said, was the debt reduction. So it's a 40% debt reduction from March 2020. So the net debt probably stands at 4,000 odd crores from 6,750 odd crores. So that's a massive, massive improvement that you've probably got. Expectations of biosimilar launches in the emerging markets, I think that can be a trigger point in terms of re-rating as this starts coming through from the next a few quarters, as I would say. The phase 2 trials for the COVID-related vaccines, I think what kind of result achievements probably come through. And when they enter into phase 3, I think that is also a potential value-added driver for the company. So I think there are a lot of positives that I probably see. The stock has run up significantly, no two ways about it. But from our only methodology, I think the EPS rating looks fair enough. I think it looks superb at this point of time. It's actually looking extremely good in terms of the institutional holding that we've got. And the demand-supply dynamics, at least at this point of time, look very, very attractive. And the earnings growth are probably supported in terms of our expected movement. So as I said, I think we had suggested this to our clients, and we do hold on to the stock with a stop loss of 390.
Fair enough. Thank you so much, Mayuresh, for sharing your views on those three counters, and thank you so much for taking the time this morning. To you, the viewers, well, the start of the week didn't pan out as we were perhaps expecting. But let's see how the rest of the week pans out. Do stay tuned. We'll bring you a lot more on the space of markets, business, and politics, of course. This is BloombergQuint.